Hello, welcome in the next video and the next unit also. In this unit, we will talk about what is liquidity and how can we actually use liquidity. Okay, let's see the definition first. If smart money or banks want to buy a currency pair, they will need sellers in the market. The existing facility to place these positions in the market is called the liquidity. The liquidity is defined by stop losses. Where the stop losses exist is where the liquidity also exists. Smart money needs to activate the stop losses of the existing orders in the market so that they can place their positions in the market. Okay, let's see some examples for this. Okay, so our first type of liquidity are the equal highs and the equal lows. The names speak for themselves. Price will form equal lows when the low points are on the same level, and also price will form equal highs when the highs are on the same level. We have two types of equal lows and two types of equal highs. Okay, let's see an example for the equal lows. On the first example, price is moving in a left and creating a series of higher highs and higher lows. After the high has been created, the first high has been created, price did a pullback, but didn't tap into a demand zone. Instead of tapping into a demand zone, it created a low. And after the low has been created, it couldn't break above the last high, and it created another pullback. After this pullback has been created, the price couldn't break below the pullback phase low, so this low point, and instead of breaking below this low point and tapping into a demand zone, it created the second bottom. So this means we have a liquidity line here, which is perfectly equally lined up, and after this, price created a new high. What can we do in this scenario? Price has a great chance to come back to this demand zone and mitigate the demand zone which has liquidity above, and sweep all of the liquidity from this region, because you have to think with the retail trader's brain. So the retail traders usually open on the double bottoms and the triple bottoms. So if they say a double bottom, they will open a buy position here. So the purpose of the smart money is to sweep all of the retail traders' stop losses, and you want to enter after the stop losses have been swept. So retail traders open a position here. They will place their stop losses on this line, but you have a demand zone right here, and you know that a lot of retail traders open the position on this line, and they have stop losses here. So you will wait for this zone to be tapped, and after the sweep of the liquidity and this zone tap happened, you can easily hop into a position and enter in a long trade, because the market collected the retail trader stop losses. So there's no more stop losses needs to be collected. So after the purge or the liquidity sweep, you can easily hop in a trade. Okay, the same scenario happens with the triple bottoms. The difference is only that price creates triple bottoms, of course. So it created the first, second, and third bottom. After it created a new high, but you have the same concept. Retail traders opened on this line. So a lot of positions opened on this line. A lot of stop losses were placed in here, trillions and trillions of dollars and sitting on this line. So market will need to sweep all of those trillions and trillions of dollars and stop losses in order to continue the overall trend, which is bullish in this case. So after the liquidity sweep, price will tap into this zone. And after the sweep and the tap, you can easily hop in a trade. The same scenario happens with the equal highs, the double taps and the triple taps. The only difference is that it's formed on the upside and not on the downside. So price created a downside movement, pullback, created the first tap, little pullback again, created the second tap, equally lined up taps. After this, price will create a new structural high. After this, price will come back and tap into a supply zone, sweep all of the retail traders' stop losses. Retail traders sell here, as you know. And yeah, that's basically all. You have a triple taps also, which is the same as the triple bottoms. Just on the other side, on the seller side, market will sweep all of the liquidity from this region too, tap into this supply zone, and after you can hop in a trade easily. Because the main purpose of the smart money is to always enter after the retail trader stop losses have been swept and taken out. So you only want to enter after the stop losses have been swept. This is a really, really, really strong confirmation in smart money concepts and supply and demand trading. Okay, let's hop into the next scenario. Okay, that's your second type of liquidity, which is the trend line liquidity. We have the same scenario, price is moving in an uptrend, creating series of higher highs and higher lows. Price mitigated this demand zone here. After this, created an inefficient push to the upside. Let's say swept the liquidity from this region because we had a double taps here. So it swept the liquidity and broke structure to the upside with this movement. So it has all the three criteria. So this is a really valuable demand zone. Price arrived in this phase with a pullback. And after the pullback, price started to form small, efficient movements to the upside, small little break of structures, zero liquidity sweep. So the only criteria here is the break of structures, but those movements are really, really slow and choppy, and we do not like them. So if price turns into this phase, we will call this a liquidity trend line because price is breaking structures to the upside slowly, creating some new highs, new lows, new highs, new lows, and these new highs and new lows will form a trend line, because retail traders call this a trend line, and they will open their positions on the trend line touches. So every time price touches this trend line, they will open a buy position here. So let's say they open the buy position here, they place their stop loss here, open the buy position here, stop loss here, opened here, stop loss here. So we have a lot of stop losses just above each other on this line. So we have really loads of stop losses sitting just below this line placed by the retail traders. So if you see something like this, and we have a really valid demand zone below the stop losses, so below this line, for example, this one, because it had all the three criteria, we will wait for this zone to be tapped and wait for the liquidity purge and the liquidity sweep. So price has a really great chance to sweep all of the liquidity from the retail traders, collect the liquidity, tap into this valuable zone, and after it tapped into this zone and swept the liquidity, you can easily happen in long trade here after the liquidity has been collected. Because as I said, the main purpose of the smart money is to enter only after the liquidity has been swept on the retail side. So you only want to enter if you know that the liquidity has been collected. If price sweeps this liquidity trend line, you can easily happen your trade here and enter on the long side of the market. So once again, on the sell side, price created this valuable supply zone because let's say it swept liquidity from this region, swept double bottoms, it created inefficient move, broke structure, so it has all the three criteria, and it started to form small break of structures to the downside over and over again. If we say something like this, it's the same like on the buy side, because price creates a small break of structures to the downside. So retail traders enter on the trend line touches, so place their stop losses just above the entered positions. So we have loads of liquidity sitting on this line again. We will want to wait for the sweep of this liquidity and tap of this valuable zone, because just think about it logically. We have liquidity, it has to be swept. We have inefficiency, it has to be filled. We have order block or supply zone, it has to be tapped. So this is a really strong confirmation, because we basically can predict the direction of the market. We can predict that price will tap into this zone, sweep the liquidity, fill up the inefficiency, and collect the orders from the zone. So yeah, after the liquidity have been swept, you can wait for a tap of this zone, and you can enter in a sell position after all of these stop losses have been swept. So yeah, let's hop into the next one. Okay, before we see some live examples, I want to show you something. So price is moving in an uptrend in this scenario, creating series of higher highs and higher lows, breaking structures, creating inefficient movements, and respecting demand zones. So after the last demand zone, so this one has been respected, price created a huge inefficient movement to the upside, broke structure, let's say swept some liquidity from this region, and created this really valuable demand zone because it has all the three criteria. Okay, sorry, let me just adjust this, and let's say it swept the equal taps here. So it has all the three criteria. Okay, after this, price started a pullback phase and failed to tap into this zone. And instead of tapping into this zone, it created double bottoms here. So this means we have equal lows, liquidity just above the zone. So we have one more confirmation because it had all the three criteria. So inefficiency, liquidity sweep, breakout structure, and liquidity creation. So basically it has 4 criteria. But let's see what happens. Price created another demand zone here because it had inefficient push to the upside, breakout structure, but it didn't sweep any liquidity. And this zone has liquidity just below it. So this zone is literally liquidity. You don't want to trade like a retail traders. If you see double bottoms here and the zone just above the double bottoms, you can't open a position on that specific zone, so this zone. So let's say price is coming down. You're happy, it tapped into this zone. You're happy, you are in profit, everything is going well. But as you can see, it created the third bottom right here. So this means you will be part of the liquidity. You want to spot the liquidity before you become the liquidity. So yeah, price tapped into this zone, you're in profit, your trade is running well. But after this, the liquidity sweep will happen. You will become part of the liquidity, and the tap of this valuable zone will happen because, as I said earlier, you want to enter after the stop losses of the retail traders has been swept. Here in this demand zone, no stop losses have been swept. So you always want to aim for that zone which has liquidity above or below. So yeah, this is a really, really important rule. You always want to spot the liquidity before you become the liquidity. Just remember this and write it down. You know what? I will write it down here and you can screenshot it. This is the golden rule for the liquidity. Spot the liquidity before you become the liquidity. So see you in the next one. Okay, another scenario. Let's say price is moving in an uptrend, creating series of higher highs and higher lows. And we have this valuable demand zone here. It swept liquidity, broke structure, created inefficient movement, just like in the last scenario. Created triple bottoms just below the zone. I mean, just above the zone, sorry. But after this, price didn't come back to mitigate the zone. Instead of mitigating the zone, it started to form series of higher highs and higher lows and continue the overall trend. Let's see what can we do in this scenario. Okay, let's say price was in an uptrend, in a huge uptrend, so it's creating highs, lows, highs, lows. So this is the 4-hour structure. This line is the 4-hour structure, 4-hour structure, 4-hour structure, and these lines are the 50-minute structure, let's say. Or for the clarity, let's say this is the 50-minute structure and this is the 1-minute structure. Okay, I will just mark it here. This is the 50-minute and this is the 1-minute. Okay, so on the 1-minute, let's say price moved like this in this region, creating series of higher highs and higher lows, reached its high point, and after the high point, it created a change of character to the downside and started to form lows, a series of lower lows and lower highs until it reached some demand point here, and that demand point reversed the price and started to form a new high. Okay, but we will have supply zones over and over again, and let's say this supply zone up here is unmitigated, and price steps into this supply zone. So sorry, I will just adjust this. So yeah, I will just remove this line for you to see better. Okay, you know that this is the 15-minute structure and these lines are the 1-minute structure. So we have this supply zone up here, but we have this demand zone down here, and we know that the trend is bullish because it's creating series of higher highs and higher lows on the 15-minute. So the trend is bullish. Price tapped into this supply zone. And after the tap of this supply zone, it reversed. Let's say it reversed, started to form lows and highs. We can expect the sweep of this liquidity on the downside movement, so the reversal. So after price reverse on this supply zone, it can sweep the liquidity from this region and tap into this valuable demand zone because it has all the 3 or 4 criteria, because it swept liquidity, created liquidity, breakout structure, and inefficient movement. So price has a really great chance to mitigate this demand zone and sweep the liquidity from this region. After the tap of this demand zone, you can wait for a confirmation entry. We will talk about confirmation entries in the next unit. So you can wait for a confirmation entry here. And after this, you can hop in a trade and you have a really great chance for price to create a new high and continue the overall trend, which is bullish in this case, as I said, because it's creating highs, lows on the 15-minute. So yeah, this is how can we use actually the liquidity for your advantage. Okay, let's see the last scenario. Price is moving in an uptrend here again, creating series of higher highs and higher lows, as you can see. I will just explain this on the drawn lines. So let's say price created a demand zone here. After the demand zone has been created, price created liquidity for that demand zone. But price actually broke structures to the upside and formed liquidity also. So we have a triple bottoms here and 3 breakout structures to the upside. How can we identify if it's just a liquidity sweep or a change of character? So if price breaks this low point, that could be easily a change of character because this low has been created a new high here. And if this low point breaks, that can be a change of character here and the change in the trend. Okay, but how can we identify if it's really a change of character or just a liquidity sweep? So let's say we have this demand zone right here. Let me just change color. Okay, let's say we have this demand zone right here and this liquidity line. Okay, sorry. So this liquidity line. Price has a really great chance to sweep this liquidity. As I said, we always want to wait for a liquidity sweep this liquidity, tap into this demand zone, and after a tap of this demand zone, it can reverse the price again and create a new high. As you can see on the live chart, I brought an example for this. Price created a low, the first bottom of the liquidity. After it created a break of structure to the upside, after it created another bottom, break of structure to the upside, and after this, it swept the liquidity from this region and tapped into some demand zone on the 15-minute here. So yeah, this isn't a change of character to the downside. It is just a liquidity sweep because liquidity sweeps will happen with huge wicks. That's the difference between the liquidity sweeps and the change of character. If you see a liquidity sweep, it will happen with a huge wick. So here's a candle and the wick will look like this, or this on the upside. So yeah. Okay, as you can see, price started to form a series of higher highs and higher lows, created liquidity here again, and with a huge wick, it swept the liquidity from that region too. So yeah, if you're on the 4-hour chart, you will want to see the 4-hour candle to create a huge wick. If you're a 15-minute chart, you want to see a 15-minute candle to create a huge wick and the liquidity sweep. If you are in the 5-minute and the 1-minute chart, you want to see a 5-minute or a 1-minute candle to create the liquidity sweep. But we will talk about this later more precisely. So hello guys, let's see some examples for the liquidity sweeps. As you can see, price was moving in a downtrend here, creating a series of higher highs and lower lows and lower highs. So here's our high point, here's a low point, high, lower low, lower high, lower low. And this supply zone caused the last break of structure. This supply zone broke the last low point here with inefficient movement. And after the inefficient movement and the break of structure, it came for a pullback, but couldn't tap into this supply zone. So can you just remember the example that I drew for you? That was a long example, but I will just draw the short example. So just bear with me. So this was the example. Price created a breakout structure here with inefficient movement and came for a pullback, but couldn't tap into the zone. Instead of tapping into the zone, it created liquidity here. Okay, after this, price broke structure to the downside again. And you could mark another supply zone here. But as I said in the explanation video, you can't open a trade on this supply zone because you have a really great chance to become part of the liquidity, because this part of the this zone will be part of the liquidity because that could be the third top or the third bottom. So if you open a trade here, you could be in profit. Price could do a pullback, but after this, price will sweep all of this liquidity line and tap into the original supply zone that created a liquidity. So this is the perfect textbook example for this, because as you can see, price created a breakout structure here. After it came for a pullback, created liquidity, just like on the example. It created a breakout structure to the downside again. You can't open a trade because you will be part of the liquidity. So let's see what happens after. And we just play price forward. As you can see, price created another tap here. So all of these taps are just part of the liquidity of this supply zone that created the original breakout structure to the downside. Okay, so price has a real great chance to sweep all of these taps and tap into this supply zone. And after the tap of this supply zone, it can reverse the price and create a new low again. Let's see. It actually created a breakout structure to the downside again and created another tap, as you can see. So more liquidity are sitting on this line. So here's another breakout structure. You also can't open a trade here because you want to wait for this supply to be tapped because you don't want to be part of the liquidity. Okay, let's just play price. After this, as you can see, price swept all of the liquidity from this region. And if you open the trade here on this region after the inefficient push and the breakout structure, it has 3 criteria, of course, but you have to spot the liquidity. If it's part of the liquidity, you can't open a trade on this region because, as I said, you are happy, you are in profit. Yes, you open the position, small profit, but after this, bam, you will become part of the liquidity. And after price swept the liquidity and tapped into the zone that caused the original breakout structure and built the liquidity up for this zone, price could easily reverse. As you can see, it could reverse. It did a change of character here, and actually this zone created the change of character after the zone tap. So it's a really important part that price tapped the zone. After a zone tap, it created a change of character to the downside. And let's see what happens. As you can see, price built up more liquidity for this zone. We have this tap, we have this tap, so we have double taps. You can't open a trade here because you will become part of the liquidity. As you can see, we have inefficiency here, we have liquidity here, we have change of character here. Price has to fill up this inefficiency, price has to tap this zone, price has to sweep the liquidity. So you can't open a trade here, you want to wait for this zone to be tapped. Let's see what happens. Price built up more liquidity, as you can see. Here's more liquidity on this line, built up for this zone. More liquidity, so loads of liquidity, loads of orders, loads of stop losses of the retail traders are sitting just above this line. So the orders and the stop losses are here. What will stop the liquidity hand? This zone. If price taps this zone, it can reverse the price and create a new low. Let's see. As you can see, price swept all of that liquidity, swept all of the stop losses, tapped into this zone, and after it has a great chance to reverse. Started to reverse. So as you can see, we had double liquidity sweeps from this region and from this region. So after double liquidity sweeps or just a single liquidity sweep, price has a really great chance to reverse and continue the bearish order flow. As you can see, that's what I was talking about. Price had to sweep enough liquidity in order to continue the overall order flow, which is bearish in this case. So once again, this zone created the original breakout structure, built up liquidity on this line for this zone. Of course, price created breakout structure here to the downside and inefficient movement, but it didn't build up liquidity here. So this zone is invalid. This zone is part of the liquidity. Price swept all of this liquidity from this region, tapped into a supply zone that caused the original breakout structure and built up the liquidity. After this, it reversed, created the change of character to the downside here. After the change of character and the zone tap, it built up more liquidity in this region. After price swept the liquidity from this region again, tapped into the zone that caused the change of character and built up the liquidity. After a zone tap, as you can see, the order flow is continued and a huge movement to the downside came into the market. So this is how you can use liquidity to your advantage. That's why I said the liquidity is the +1 criteria, because it's a really, really strong confirmation. So here, only 2 criteria happened: breakout structure and inefficient move, but price didn't build up liquidity, and this zone built up liquidity. So this zone is more powerful than this zone. So you will wait for the tap of this zone and the liquidity sweep. Okay, let's see the next example. So let's see another example. As you can see, price created inefficient push to the upside from this demand zone. It broke structure, and after the pullback, price couldn't tap into this zone. And instead of tapping into this zone, it built up liquidity here, also here. So all of this region is liquidity for this zone. So just imagine how many retail traders opened positions on this line, on the trend line, or I don't know how they call it, the resistance or support. I don't know. So just imagine how many retail traders open positions here. So all of the stop losses are located below this line. So the stop loss is located somewhere here, and this zone could hold the liquidity sweep. After this, price started to form series of higher highs and higher lows, but with slow movements, as you can see, choppy, wiki behavior, slow movements, small break of structures, small inefficiencies, or even no inefficiency. So this means this is a liquidity trend line. As you can see, we have a trend line here, and price kept touching this trend line over and over again. So retail traders open their positions on the touches of this trend line, even here. So all of their stop losses are located just below this line. So this is a liquidity trend line. We have liquidity here. So sorry, we have liquidity here, we have liquidity here. So price has a really, really great chance to sweep all of this liquidity, all of this void, and tap into this demand zone, because liquidity was built up just for this zone. As you can see, this is the next zone, I mean the last zone before the liquidity build up. So price built up liquidity for this zone, and price is a really, really great chance to sweep all of this liquidity, tap into this zone, and reverse the price to the upside to continue the overall bullish order flow. So as you can see, this is what happened. Price tapped into this zone. After a tap, it immediately reversed and started to form a series of higher highs and higher lows again to continue the overall bullish order flow. So yeah, liquidity is a really, really powerful tool. You really want to master it because you want to spot the liquidity before you become part of the liquidity. This is a really important golden rule in trading and in liquidity concepts. Always spot the liquidity. Always. See you in the next one, guys. Okay, so let's just talk about the liquidity sweep or the change of character. I talked about this in the earlier video, but I just want to clarify things more precisely. So let's say price is building up an uptrend, creating series of higher highs, higher lows, highs, lows. But price actually created a liquidity line here, which is a triple bottoms. So I will just mark it as a triple bottoms here. Okay, so as you can see, this low point has created the last high. So if this low point breaks, you can call it a change of character. But how can we identify if it's a change of character or just a liquidity sweep? Let's say we are on the 4-hour time frame. So I will just write the 4-hour here. So we are on the 4-hour time frame. If we see a candle like this here, it can also be a red candle, solid downside candle. It doesn't matter, a color doesn't matter. So if we see a candle like this with huge wick, and a huge wick taps into a demand zone, or it doesn't have to tap into a demand zone, it just have to sweep the liquidity. So if a huge wick sweeps the liquidity, then you can easily know that it's just a liquidity sweep and not a change of character. Because if price does not create something like this and it just bodies below this line, then it will be a change of character and it will stay below this zone. But if it wicks below the liquidity line and it immediately comes back up on the 4-hour time frame, then you know that it's just a liquidity sweep and not a change of character. But the same concept goes on the 15-minute time frame. So if this is a 15-minute structure, then you will want to see a 15-minute candle and wick does something like this. So you are on the 15-minute, I will just write it to the 15-minute. And on the 15-minute, you want to see a 15-minute candle do something like this. If you are on the 5-minute, you want to see a 5-minute candle do something like this. If you are on the 1-minute, you want to see a 1-minute candle do something like this. Because let's say you are on the 4-hour. No, let's say you're on the 15-minute, say with the 15-minute. So this is the 15-minute chart. And the 15-minute candle does something like this. If you switch to the 1-minute, you will have 15 candles on the 1 minute, that just equals to this 15-minute candle. So you have a chance that those 15-minute, 1-minute candles will just stay below and close below this line. So you won't really see that it's a liquidity sweep or not, because it's the 15-minute liquidity. You want to see a 15-minute candle to sweep all of that liquidity. So yeah, I hope it makes sense. Let's move on. Okay, let's see a live example. So as you can see, we have this demand zone right here. It created inefficiency to the upside and changed character here, started the whole bullish order flow. Okay, it's not about the demand zone right now. It will be about the liquidity. So as you can see, we have bottoms here, 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 here. And these are almost perfectly lined up, creating equal lows. So equal lows above the demand zone means if these lows will be swept, this demand zone can hold the price and reverse the price to the upside. So just think logically again. We have these lows. Retail traders open their positions on this line, so their stop losses will be located just below it. So just below their stop losses, we have this demand zone. If price sweeps the lows, sweeps the liquidity, this demand zone will hold the sweep, and it can easily reverse the price, as I said. So as you can see, price tapped into this demand zone with a liquidity sweep, because we are on the 15-minute chart currently, as you can see. And this is a 50-minute candle right here, this one. And it looks like this. Small body, really small body with a huge wick to the downside. So this means this was only a liquidity sweep. And after this, price can easily reverse and continue the bullish order flow. So let's just test it. I will show you. So as you can see, after a liquidity sweep, it just blew to the upside. This means the market collected all of the stop losses, and they could place more buy orders because the liquidity, the stop losses have been swept. They could place more buy orders on this zone because it reverses the price, and it can continue the overall order flow, which is bullish. Okay, but let's see these sweeps. We just play price, not play price, sorry, stop it. So we just forward price here. Okay. So on the 50-minute, this candle just looks like a liquidity sweep. Let's see, it opened at exactly at 9, and the next candle opened at 9:15. So on this movement, we will have 15 1-minute candles, and those 1-minute candles will look like a break of structure and the continuation of the bearish order flow, because in this region, we have a bearish order flow, as you can see, series of lower highs and lower lows. Okay, price broke through this last structural point, we can say that. So we can expect supply trade here if we are on the 1-minute chart. But we know that it was just a liquidity sweep and not a break of structure. And after a liquidity sweep, we will expect the order flow to be continued. So if I switch to the 1-minute chart, you will see that this is 9 a.m. The 50-minute candle opened here. And this is 9:15, it closed here. So on the 1-minute, as you can see, we have 15 candles, and those 15 candles just broke the structure and started a pullback. So if we only trade the 1-minute chart, that's the importance of trading correlated timeframes. So if you're only trading the 1-minute chart, we will think that is a break of structure to the downside, and we will open a supply trade here because it created inefficient movement and the break of structure here. But we trade multiple timeframes, so we will know that this was just a liquidity sweep on the 15-minute, and it won't confuse us on the 1-minute, because we know that the liquidity has been swept, and we will look for long entries inside of this demand zone. So as you can see, it was just a sweep on the 15-minute, and after the sweep and the liquidity collection and the demand tap, price started to continue the overall bullish order flow to the upside. So that's the importance of knowing if it's just a liquidity sweep or a change of character or a break of structure.